Good morning, everybody. I'm Russell Sturm. I represent IFC, where I've led our work in energy access for a good while, and have been with this off-grid solar industry since its inception and watched it mature. And I've seen a few different game breakers over the course of the industry's development. The first ones were really around technology, and then the next one really became around the business models that enabled distribution of products that were life-changing events for people, where there was an insatiable demand, but a challenge of getting the right products to the right people in an affordable manner. And so the development of pay-as-you-go solar was the next really big game changer. And we have seen the impact of that, both in terms of reaching more people, but also being able to transition off-grid solar from the notion of a solar lantern to a complete suite of both household and productive use energy services. But for PAYGo to reach its potential, really this hybrid business model that has had to layer on some form of manufacturing, distribution, service, consumer finance, and yielded these businesses that don't really look like any other businesses that investors have seen before. We have to have a way to help that sector develop and mature and be understandable and recognizable and discernible from the perspective of the investors whose capital is essential to realize the full potential. And so what emerged out of this, actually going back more like 2016, when IFC started to look at the experiences of the microfinance sector, where similarly you had a game-changing business model to reach a previously unaddressed market. Yet those businesses those banks, those non-bank financial institutions, didn't really look like anything that investors had seen before. So it wasn't until they developed standardized KPIs that they became recognizable and dealable for investors, and capital flowed into that sector. And after having gone through some exercises where we developed an alpha and a beta version of some KPIs that we thought could capture the financial performance of these PAYGo companies, we came together in a tripartite partnership with CGAP and GOGLA to really facilitate a process that's owned by the industry, resulting in 24 working group meetings, 3 different working group verticals to develop and refine those definitions, taking into account all the array of performance criteria. So I'm here representing the steering committee of that tripartite partnership, where I work alongside Jeff Manley from CDC, Javier Faz from CGAP, and Kuhn Peters from GOGLA. And we'll be hearing from the engine behind this work, the team that's actually been facilitating the process, refining it, making the tough decisions that have resulted in the PAYGo Perform KPIs. And so essentially the thesis and the ethos underpinning this is that it would be a collective and a transparent and an industry-led process that the industry would own. And now we're in a process where the ownership, after having developed, revised, tested these KPIs, we're taking it to the market, where not just the acceptance and use by the industry is critical, but actually the acceptance and use by investors. And I actually came to this meeting from another meeting where we were appraising as IFC an investment in a PAYGo company. I tell you, these processes of trying to introduce PAYGo into a financial institution would be a lot easier if there were these standardized KPIs already in place. So I look forward to this launch of the technical guide to enable this to happen. So the issue is investors simply don't understand these strange beasts of PAYGo companies. And therefore, they do a couple things. They bring inappropriate KPIs to the table that actually just don't reflect the nuances and the specifics of PAYGo companies. It reflects a company that we'd seen before in distribution of products, or KPIs that reflect a bank or a leasing company, where straight par 30, par 60, par 90, defined as you would define it for a bank, tells you one part of the story, but it doesn't actually tell you about the performance of that portfolio or that company. And the result is perceptions of risk for the sector are high. If they don't want to be burned. You don't, as an investment officer or a credit person, want to assume you understand something you don't understand. And the result is institutions back away or overlayer inappropriate criteria. They don't actually capture the risk appropriately. And additionally, from someone that's been with an institution just like CGAP and GOGLA, who are interested in the growth of the sector, until we can benchmark operations, the ability of individual companies to improve themselves and understand where they're flagging or where they're leading, the ability of investors to prioritize who and what type of entities they want to invest in, is just not there. And it leads to a lack of transparency, thus redoubling the concerns of investors in the sector. And we're not going to get that $6 to $11 billion of capital that this business model can absorb in order to help us get to SDG 7. So the standardized nomenclature that describes PAYGo company performance and creates a reporting mechanism that allows us to track performance, allows investors to screen investors, and allows us to get industry insights. That's the output of this effort. Next, please. So you apply that thing in that output in a number of different ways. The first is really understanding a company's performance, which then facilitates the appraisals of investors and allows us to structure deals. So if we don't know what we're measuring in terms of the performance of a company as an investor, it's difficult for us to understand how we structure to manage risk, and additionally, how we structure it such that we have identified the milestones that allow us to trigger disbursements. Our loans won't have as one single disbursement. And so understanding how we get deeper in our second and third disbursement of a commitment that we make, and when the appropriate time is that reflects the PAYGo company's actual need and their actual ability to deploy the funding, and their actual demonstration that the funding is being deployed in the first tranche as appropriate, it's not there as well. Additionally, the reporting in the microfinance institution sector, we were able to create, or the sector was able to create, a reporting platform which reduced transaction costs for financing. PAYGo companies have insatiable appetites for debt. And so it's not a one transaction and then we're done kind of thing. They will have a portfolio of lenders, a portfolio of investors, and being able to report in a standardized way onto a platform to meet the needs of multiple investors only becomes an efficient proposition if those investors are speaking the same language, and the same language as the PAYGo. Finally, understanding what's going on in the sector is a head-scratching exercise, and there are as many data points as there are opinions about what is really going on in the sector. If we can standardize with accurate metrics what it is we're looking at, it will help us understand what the sticking points are, help us understand what markets to go into, help investors understand relative risks across the sector, and help companies to create standards against which they work. So with that, my general introduction, I'm going to turn it over to the real experts, the folks that have had their hands on this from the get-go, representing CGAP, Nikki Kaki, Rowan Borst from GOGLA, and Kevin Kennedy, representing IFC. And I'm going to hand it off to Nikki to pick it up where I've left off. Nikki?
Thanks, Russell. At the outset of this initiative, we surveyed stakeholders to understand which KPI categories were most important to include. Respondents and workshop attendees selected 3 overarching categories: portfolio quality, unit economics, and overall KPIs, which became company and operational indicators. Working groups were then created to tackle each of these sets, drawing from the expertise of companies, investors, and other PAYGo Solar stakeholders. Each team produced a set of KPIs, which were then tested in a pilot with 8 companies. Armed with pilot data, the teams reconvened to finalize the list, settling on the 36 KPIs you see before you. Let's walk through each of the categories. Next slide, please. How does a PAYGo company go about transforming a sale on credit into cash? The portfolio quality KPIs are meant to help characterize the risk involved in this process. PAYGo Solar is a diverse industry, but there are some common features that translate into a distinct expression of risk. This means that some of the metrics that are used to measure risk in other industries may not tell the full story. Through many working group discussions and piloting, balancing availability of data, ease of reporting, and informativeness, the working group members came up with 8 KPIs portraying 5 different dimensions of portfolio quality. Those are risk, size, growth, repayment rate, and receivable tenor. Even with common definitions, there are many different slices of portfolio quality one could analyze, each providing valuable information. We've made suggestions of high-level calculations of these KPIs to improve comparability across companies, but flexing these indicators around variables such as periodicity, cohorts, geography, product class, and others can provide valuable insights. Further, these KPIs, as with the other PERFORM KPIs, only paint part of the picture. They're meant to be used together within the portfolio quality set and also across the broader PERFORM KPI categories. For instance, when a company writes off a slow-paying or non-paying customer, this can positively influence the indicator tracking overall repayment, what we call collection rate. Additionally, high levels of growth can influence risk measures if newer customers exhibit different repayment behavior than older customers. Of course, we need to also be mindful of the bottom line, as a company may be intentionally reaching out to riskier, underserved customers, and in doing so, may be successfully buffering the additional risk with higher prices or rates, which would show up in the unit economics indicators. Many of these relationships are highlighted in the forthcoming technical guide. Next slide, please. Flexible repayment offers up an interesting challenge for describing risk in the PAYGo Solar industry. Metrics used for traditional finance may miss some of the critical components. Let's take this example with 4 different customer profiles where each box represents 10 days worth of payment. PAR 30, which is typically used to measure how long a customer has been behind on payments, would include all 4 customers. But customer 4 should be considered a good PAYGo customer and likely customer 1 as well. If instead we use consecutive days unpaid, which resets every time there's a payment, then only customer 2 would be flagged. Finally, if we use a threshold collection rate, which considers cumulative payments over a period of time, we would include both customer 2 and customer 3 in the screen. In particular, a sole focus on non-payment neglects the risk associated with slow payment. Slower payers can, in some instances, end up costing a company more than quick non-payers. They can also turn into non-payers, so it's a group that would be sensible to track. All that's to say, adding collection rate to the risk measurement toolkit can provide a richer view of the risk that PAYGo Solar companies are exposed to. And with that, I'd like to hand it over to Kevin to take you through the unit economics KPIs.
Great afternoon, everybody. Thanks for joining us. So my job is to talk you through the unit economic metrics. Even though it represents perhaps the biggest part of the total metrics, there's 18 in total. I mean, the good news is for, I think, the attendees of this call, we're all familiar with the usual management information we receive. So for us, we really faced two, and in doing so, we had to resolve some few issues in that. So as Russell referred to, and we're all wrestling with the same thing, we're looking at two different business models. We're looking at a short cycle business, which is, let's say, the retail sale of solar equipment. But in fact, we're doing that on credit, which takes us into a medium to long cycle business. So there's statistics that characterize each type of business that don't necessarily come together spontaneously. We have to do some work to resolve that. So we can see, obviously, in a retail business, you're buying stock, you're converting that to sales, you have a particular type of distribution model. You have when you go to a bank, they want to look at you as an SME trading company. However, with a consumer financing business, you have a portfolio, you don't get your cash back for quite a while. You have to support your customers through the life cycle of collecting cash. You're made to engage in repossession, and certainly there's a lot of delinquency that has its own costs, its own staffing. You have financial cash flows rather than trading cash flows. So we have to find a way to define a set of metrics that work for both of these businesses. So a couple of the things we had to resolve included, what is a sale? What are the elements of profitability that are important that our funders understand, and some perhaps more technical issues at the level of what are fixed and variable. How do we lay out the costs in a coherent way for our investors, for interested stakeholders? So before we go to the next slide, just to make the point that in identifying these KPIs, they're not just for external consumption. It's very easy to think of them in terms of raising finance, and obviously that's a hugely important function. But we have two other areas to consider. One is other interests, academics or the general public. We have to be able to describe our social impacts. But also, we believe the KPIs are a very good internal reporting structure. And particularly for young companies joining the sector, if they look at the list of KPIs and aim to be able to report on all of them, they will not only assist their external communication, but we believe they'll benefit from their internal reporting as well. So if we move to the next slide, please. So the good news for these 18 unit and firm level KPIs is they flow very, very easily from existing financial statements. And that's external financial statements and internal management accounts. So you're going to see familiar cost categories. But the key thing is to resolve what is the basis of revenue. So we had to choose, pending further discussion, we had to of getting a common basis for reporting on sales revenue. And for this, we used cash receipts. So this is something that we're all tracking very clearly. Everybody knows what their cash flows are. So that gives us a good denominator for most of the metrics. There is a work that is ongoing, and in fact, we will have some output imminently, where we're preparing a briefing for the sector, for the same working groups, on where perhaps we might go on accounting principles for the sector. But for this piece of work, in order for us to proceed, the key decision we had to make was to use cash receipts instead of sales as a proxy. I mean, the issue with sales, of course, is when do I identify a sale? When the customer gets the goods, when they finish paying, or somewhere in proportion to both of them. We've chosen cash receipts as the best resolution of that. There are other issues, including, what is the provisioning policy? Where do certain costs sit? Are they fixed or variable? Are they semi-variable? The way we resolve that is to retain the visibility of where these costs are and make it clear when we have consolidated metrics what makes them up. So the key takeaway, I suppose, when you look at the metrics, you'll find them familiar, as I say, as any accountant or analyst will easily be able to prepare them. But in terms of using them, you need to see these as the basis of a discussion, which should be in the context of asking the particular company that you're talking to, what is their accounting policy? With regard to the burden that they might represent, that is the same as your normal management accounting decisions. How often do you need this information? But certainly, we emphasize that you need to understand the underlying accounting policies when using these metrics. So just to close, I would say that I've already personally participated in 3 briefing sessions with banks who are facing the issue again that Russell referred to, which is how do we capture all the aspects of a pay-as-you-go company, and they are finding the KPIs a very interesting solution. So I do hope and propose that this is going to become the language of the sector. So with that, I'll hand over to my colleague Ron. Thanks.
Thanks, Kevin. Yes, so some of my speakers already shared. I think, as you've seen, the PAYGo companies are often doing it all. They have to design the product, they have to manufacture it, they have to do the sales and distribution, and offer customers as well the financing to obtain their product. This doesn't only provide a challenging for companies to manage all these different operations, but also makes it challenging for then investors and other stakeholders to really fully understand these businesses. Not having a standardized way of categorizing companies can also make it challenging to engage in more benchmarking for companies to improve their operations, and for investors to also fully have the information to evaluate an investment opportunity and allocate the right capital. So these company and operational indicators are really a group of indicators that hopefully can help solve some of these challenges, and are around 4 different areas. So first, for the business model in context, these indicators are really there to really gain better that understanding of the business model. So you can, for example, also see that if you look at the sales model, you can fully understand, is it a PAYGo model or is it more of a cash model, where then an investor can also infer its typical financing needs. So for example, for a PAYGo model, a company would need more frequent and potentially also higher capital injections. Then with the other 3 groups, the sales performance, distribution performance, and consumer satisfaction and loyalty, you can deduce from a high level how the operational performance is of a company, and also its current growth from a more high level. The consumer satisfaction and loyalty indicators can, for example, also provide some information around the future potential growth of these companies as well, by looking, for example, at the repeat sales. So in total, in summary, these indicators can help in really gaining that understanding of the business model, deduce the operational performance, infer some of those typical financing needs, and also enable really that benchmarking and do cross comparison across these indicators, but also the unit economic indicators and the portfolio indicators as well. Next slides. So to ease the implementation of these KPIs, the PAYGo Perform team has also curated about 4 different tools and knowledge products. So first, you have the data collection pilot report, which is curated by the MFR team. And that really tells the story and the journey of the KPIs that were developed with the working groups to the KPIs where there are now, and really the final list of KPIs 2.0. The technical guide and the Excel tool are really there to help all stakeholders to implement the KPIs, and can show in detail how these KPIs should be calculated, and can also provide a tool to then report on these KPIs either internally or externally to stakeholders or investors. Then lastly, there's the PAYGo Solar Industry Accounting Guide, and this is following a little bit of what Kevin has shared earlier around the differences in the different policies of accounting principles within the companies. And it will really kind of highlight the need for commonly accepted accounting guidelines to then also enhance the value of the KPIs, as well as enhance the quality, let's say, of the cross comparison around of companies. Next slide. Here you can see a bit of a sneak peek of the technical guides. So you can see that for the technical guide is structured around the three areas, so the portfolio quality, unit economics, and company and operational indicators, as we have shared today as well. And through each of those 36 indicators, it really provides very in-depth knowledge around how to use these indicators, how to implement them internally, and some at times also provide some illustrations to really help you implement these KPIs. The technical guide, as well as the data collection pilot report and the Excel tool, will be published later this week, where the accounting guide will follow later on. Next slide. So next, I would like to introduce Jeff Manley. Jeff Manley was a steering group member of the PAYGo Perform initiative, and also had and also is an investment director and head of energy access and efficiency at CDC. He has also been championed the PAYGo Perform initiative for the last 3 years or so as the co-chair of the unit economics working group. So with that, I leave it over to Jeff.
Great. Hi, everyone. Thanks so much, Rowan. Very excited to have everyone today and to be moderating this panel. We've got a lot to talk about and a really interesting group of panelists, I think, that represent the industry very well. So eager to jump right into questions. I'm just going to very briefly introduce the panel and then we'll jump into those questions. So we have Sarah Majabi from Greenlight Planet. We have Tobias Ruckstuhl from Persistent, and we have Fabian Gilfillian from Ulu Solar. So we've got companies and investors and can benefit from their perspectives. So just to kick things off, like to start with a question that we could just go around the table and ask everyone to introduce themselves in a bit more detail, as well as their organization. And then just tell us a little bit about your experience with the PAYGo Perform initiative and how you've been using that thus far. So let's start off with Sarah, please. Can I hand it over to you? And can I ask everyone to turn on everyone on the panel to turn on their cameras?
Yeah, thank you so much, Geoffrey. I'm Sarah Amijabi from Greenlight Planet. I am the global head of risk. I have attained over 12 years experience in international and indigenous experience working with financial sector and renewable energy. Mainly overseeing credit risk and risk management, development of risk frameworks, loan products, and collection, as well as IFRS 9 provisioning. I'm very excited about with this topic that we are talking about today, because I was actually involved in portfolio working group. And one of the things that is really exciting is how we started and where we are today. So it was quite interesting that I liked the approach that we took, and the approach was very detailed. We had a lot of detailed discussions from different stakeholders, investors, PAYGo members, as well as other external parties. And there was a lot of discussion and iterations where we looked at surveys, pilots, and looked at the feedback of these pilots. And today we arrived at the KPIs we are talking about today. And why this is quite interesting and very important at this time is because PAYGo company has been growing exponentially in the last few years. And we've not been able to really articulate what are the risk thresholds of this sector. Some would say it's low risk, some would say it's high risk, but today we are looking at how do we standardize this, and we can easily communicate it internally, externally, and even allow investors to be able to access this sector properly. So in my view, the proposed, or rather the KPIs that we arrived at, are really concise, capturing the characteristics that most importantly are able to give a high level understanding of a company receivable, portfolio quality. And it's a good thing because we are able to balance the cost of measurement and reporting and how sensitive information is going to flow through. I think at this point, what is actually coming out very clearly is that these KPIs are going to be very crucial for benchmarking and comparability that will help in due diligence, and will also help in internal and external benchmarking of performance. So I think, having been in part of the working group, I'm very excited to see where we are today. And just those are the insights I've had while working with the groups, as well as my own understanding of these KPIs and how they're going to be beneficial to the sector. Thank you.
Great, thank you, Sarah. And can I now ask Debian to come in, introduce yourself, please, and tell us about your experience with the initiative so far. Debian, I think you're still on mute. If you can.
Apologies.
There we go. Thank you.
Great, thanks. So my name is Fabian Gilfillian. I work with Ulu Solar as finance director. Ulu started in 2015 in Senegal, and since expanded to five other countries in West Africa. So as a finance director, I also overlook the department within Ulu that is responsible for pricing and credit. It was this function that contributed or was within one of the working groups, portfolio and unit economics. So we provided feedback on definitions and also the calculations. Also benefit from a credit consultancy as well, which emphasized those KPIs, and implemented kind of the portfolio performance framework to use and unit economics measuring framework. I guess kind of mirror what Sarah said in terms of the importance and benefits of these frameworks. Firstly, for us, it's important to have a consistent way of looking at the company, consistent definitions as we build and kind of make more concrete the way in which we look at the performance of the company. It's a lot of work from the ground up, and therefore there can be some confusion amongst departments. So it's good to have a kind of a harmonized way of looking at the company, and having the input of kind of external parties that can work specifically on that and dedicate a substantial amount of time to that is important. And then secondly, being able to harmonize across the industry and therefore speak to investors about differences between companies, as opposed to starting an education process with each investor is really valuable, saves time, and also allows us to get to kind of more insightful conversations with investors and speak about building facilities and investments that really suit the company specifically.
Great, thank you, Thibian. And can I ask Tobias, tell us a little bit about yourself and Persistent and your experience with PAYGo Perform.
Yeah, sure. Thanks, Jeff. I hope everyone can hear me well, and great to be part of this panel. So yeah, briefly on myself, Persistent, and how and why we're involved in this initiative. So Tobias. I'm partner and CFO at Persistent. Persistent is a venture builder focusing on climate topics in sub-Saharan Africa, with a particular focus on access to energy, and have been at that in the last 10 years already. So nearly from the start of when the sector evolved. As a venture builder, we invest at the earliest stages, not only financial capital, but also human capital, which in practice means we often are also involved in an operational way, also filling interim management positions, often interim CFO positions, as myself have done as well in companies, in early stage companies, and gives us kind of a very special view into the sector. And when we talk about this topic, so both from an investor perspective, where we analyze countless companies, especially early stage ones, but also late ones, but then also often are then on the other side working with the entrepreneurs to actually implement these KPIs and potentially raise further capital and make both of these experiences. And so in most aspects, what we do, we try and bring really both of these perspectives in. As Persistent has evolved from the start, it was important for us to contribute to the development of the sector overall. I think we heard it from Russell, but also Jeff, everyone, how important this sector is and can be, and how much more potential there is. And so for us, it was always important to share some of the insights as well publicly. So that ties in as well why we are engaged in this initiative as well, since we also publicly shared our business analytics toolkit for the PAYGo space early 2018, and then it was only very logic that we also decided to actively be part of this really great initiative to take the KPI 1.0 framework to the next level. And so ever since I've been involved very closely, specifically as a co-chair for the portfolio quality working group myself. I think that was also started end of 2018, potentially in 2019, and have as such interacted with most of the people that are actively speaking here, but also many more. And if I can speak briefly to that process, I found it was a really inclusive process where as on the panel today, big companies, small companies, investors, debt investors, equity investors, software companies, such as Angaza or PayGops, and really, all coming together in a very constructive way, and ultimately with the goal, that is the defined goal for these KPIs, to bring some common understanding in. And for me, a key takeaway was how much I think everyone can benefit from just taking the time to take a step back and think of what do we actually want to measure, how do we measure it, and take that time and the outcome that we've now come to and are launching now, which is great. And thanks for everyone who's contributed here. I think is a very good one and reflects all of these discussions that we've had internally, and also with all of the stakeholders. So yeah, excited to have this launch event now.
Super, thank you, Tobias. So I think that gives us a great sort of introduction and overview. Heard some interesting themes coming out, talking about benchmarking and due diligence, as well as inputting into important questions like pricing and credit. I'd like to go back and ask some more specific questions. Maybe I can start with you, Sarah. So working at Greenlight Planet, which is one of the largest solar home systems companies, you're operating in a number of different markets around the world using different sales and distribution models. In some cases, you're selling directly to customers. In other markets, you're working through partners. And just wondering if you could talk through any challenges that you may have faced in using the KPIs, given those different country contexts and aspects of your business model.
Thank you. Dr. made clear, is there's been a lot of learning on the way in the past about trying to set ourselves our data structures and our performance metrics in a way that we can easily, be able to measure our own internal KPIs. And at the time when we were trying to, when we were having this discussion about these new KPIs, we'd already set up some standards in the way we were internally measuring our own internal performance. And they were not very different from what we are talking about here. And the good thing about the discussion today is that we are trying to bring in different aspects of performance and try to correlate them. So we are looking at unit economics, we're looking at operations, and we're looking at portfolio quality, which is bringing different insights to more or less what we've had. So when you look at challenges, I think one of the things that was easy for us is because we've already had those type of structures in place, and we've already tried to map our metrics in place. So it wasn't really a challenge. One of the things that maybe we will need to do is just to try and structure some of the other additional KPIs that we had identified in the portfolio quality, and like write-off or even the rates of repossession, the way we had highlighted them, to be able to get more insight from the different markets. Having said that, for us, one of the learning curves is that looking at the way the KPIs have now been, they have been standardized and they've been structured, it will really go a long way for us in terms of helping us to have better insights on certain aspects of our different markets, which we might not have really correlated different operational KPIs as well as portfolio. And so it will give us better understanding, and looking at the way we've really articulated and simplified the metrics in a way that we can easily collect that data, we can easily analyze it. So it will be easy for us to correlate performance and be able to have a deep dive in analysis and give us some, very clear outcomes in terms of how we want to solve for challenges or derive solution or strategies because of the way we have defined. Thank you. Did you hear me?
Yeah, I think at least on my end, you froze for a moment, but I think we got the essence of your response. So thanks for that. And then maybe just similarly, Thibian, looking at your organizational context, very different one, West Africa focused, distribution focused. How has your experience been in implementing these? Has it created any challenges, either from a systems perspective, or has it been a relatively smooth process?
Thanks. So I think it was relatively smooth, how I would characterize it. We've, over the last kind of 3-4 years, been looking to have more kind of ability to make data-driven decisions. And therefore we're setting up kind of processes for that, mainly relying on kind of BI tools. We first started with the portfolio and are now moving towards more kind of operational and financial metrics. So this kind of dovetailed, and the timing was quite right as we had kind of set up these BI tools for the portfolio. And the main benefit from the working groups and the KPIs was to kind of really fine tune how we were thinking about these KPIs. And also understands what kind of slight difference in definitions of these KPIs and kind of the uses of these KPIs could produce, and therefore understand a bit better the variables in the portfolio, and all the way down to understanding differences in what differences in customer behavior would produce in terms of the portfolio. So it's not that many challenges, a lot of kind of thinking to do in terms of agreeing on how we understand portfolio profitability, how we understand kind of longevity, the different connections between the variables, and also what we want to focus our strategy on optimizing as well.
Okay, great. I'm going to ask a few more questions, but I did want to encourage everyone to go ahead. If you have questions, please put them in the chat. We're going to have some time in a few minutes to pick up those questions. So please do raise any points you have in the chat. Thanks. And then turning to Tobias. So, you know, on the other side of the table, really, from the investor perspective, maybe you could just sort of let us in a little bit to your diligence process and how you would use these types of KPIs generally when thinking about investment decisions, and how, you know, the KPIs that we're talking about here can help you with those investment decisions.
Yeah, thanks, certainly. So, you know, of course, as a reminder, this is a bit the viewpoint from an investor who typically, you know, we invest very early, you know, so so not necessarily, you know, the very late stage companies. As such, you know, probably it's fairly clear that the unit economics KPI are the most relevant ones, and the ones that we have always been focusing on first, because that's of course what needs to be right. And as such, you know, for the ones who know the KPI 1.0 framework as a comparison, I think there has been now quite an overhaul, you know, and refinement, especially on the unit economic side, generally as well, but also especially on the unit economic side, and you know, really a step forward there. And what that means is, you know, companies that are already familiar with these unit economic KPIs will certainly be in a better place to just, you know, have more efficient discussions, while we might have, you know, additional or sometimes slightly different unit economics, you know, KPIs or ways of visualizing it. Certainly companies that are already used to you know, thinking of displaying, calculating, tracking the type of unit and economic KPIs that we have now in this framework will certainly be, you know, at a significant advantage, and just way more efficient process, because there will already be, you know, a joint basis, and we would often be referring to the KPI framework. So far to the beta version that was online, but now obviously very soon to the you know, final version. And so that definitely gives companies a head start to already, you know, think of it in that way. On the portfolio quality side, that is of course a bit more relevant for companies that already have a, you know, a more significant portfolio size, where it also makes sense to look at these indicators and draw conclusions from it. Again, there, from our perspective, it does, as an investor, it does help to make even these initial calls a lot more efficient. Often, as you know it as well, everyone on both sides, you have, you know, half an hour initial intro calls where you try and get to know the company quite well. And we, and I in particular often ask, you know, try to understand these businesses by asking some of these figures. And obviously we all know, if you then say, okay, can you give me an idea of your collection rate, you know, as an example, and then you spend 15 minutes trying to understand what each other means with collection rate, that definitely makes it more difficult. Whereas even if, you know, the company might be tracking a slightly different version or a different definition of the collection rate, but at least is aware of how it relates to, you know, the KPI 2.0 framework, you're already much quicker on the same basis, where the company can say, look, you know, either this is it according to the framework definition, or this is it, and this is the major difference to the framework. And that does truly make a difference in a setting where, you know, probably no one has too much time, and, you know, these first even half an hour calls can be quite important to get a sense of where the company stands and try and make sense of it all. You know, obviously could go much deeper once we then look at the company. As said, we're quite a hands-on investor who, if we do a due diligence, we're also happy to work with the companies to figure out the exact KPIs. But certainly from our point of view, it can make the biggest difference is almost in really these initial phases where time is of the essence. And if you get a good understanding in the first half an hour, that can make a difference whether you pursue the opportunity or not.
Great, that is really insightful. I think speeding up understanding, creating a common language, so that even if you're not necessarily using the exact definition, you can quickly understand where people are coming from or what differences they might be introducing. So really helpful. We're coming up short on time, but I have a question that I wanted to put to both Sarah and Thibian. And as the following. So, historically, PAYGo companies have been notoriously protective of their data. They haven't wanted to share it with others. And I'm just sort of wondering, as participants in the pilot and sharing data, how did you sort of get comfortable with sharing that, and what advantages ultimately did you see that sort of outweighed any potential negatives of sharing your own data?
Thanks for that question. So one of the things that the iterations we had during the development of the KPIs were very clear in terms of ease of reporting and standardization. And discussions went about anonymizing reporting and how we can upscale these KPIs with making sure that every other stakeholder feels comfortable. So, with the idea of non-disclosure agreements whereby we report and really we don't have to, share the name of the organization at the level view where we are discussing cross company, that really gave confidence in terms of that data. And I think just from a goodwill and confidence about these KPIs and looking, I think as an industry, a lot of sensitization for different stakeholders in terms of what we need to have in place and having confidence that our data is going to be used for the better good of the sector, as well as help investors to understand without necessarily putting a name and tag to the data owners. That sensitization just from the start of developing these KPIs was very important. And that really helped in terms of, moving forward to even pilots. And one of the things that was even great when we looked at the results that came from these pilots, it was very clear that there were no tags. It was very clear in terms of helping us understand the dynamics of performance of the sector. And, this just boosts our energy and, much focus to do this more often and have very good standards of, putting measures where we can know that these are the timelines we have for reporting, and this is what type of data will be collected, and this is the long-term benefit to us. So I think one of the things that we should take away from today's webinar is that let's look at the long-term, the long-term goals of these KPIs, look at how they're going to advance the sector, and also where members feel that, there are some issues to do with data privacy and sensitivity of data, then we need to do some sensitization, even invest in that so that we have some confidence to make sure that everyone is on board. That is what I would say. But for us as Greenlight, I think we've done this a couple of times, and we were looking forward to being part of this pilot, and it gave us very good results. One thing I would say about the results is that from the results we saw in the pilot is that we saw a lot of resilience in the sector itself, because looking at the data results that came, we were able to compare with other sectors, financial sectors, and we saw that the PAYGo industry in terms of performance was able to sustain performance during COVID, and unlike other sectors we saw outside there. So that is just showing the resilience of the sector we are dealing with and the importance of having some level of benchmarking and standardization that can give better insights, both internally and externally, for people to understand the performance. So I think that was quite interesting and quite good results from the pilots. Thank you.
Great, thank you for that. And then quickly, Thibian, anything to add from your perspective from the ULU viewpoint?
Yeah, I'll say we'll one of those in the lot that needed to get a bit more comfortable with the concept of sharing information. What helped was from the off being very clear about what was going to be done, or it being very clear about what was going to be done with the information and the methods that were going to be used for standardizing and then also anonymizing the data. And then also understanding exactly what would be shared and what format. So like visibility or transparency on the process was important for us. Also, just looking at the actors who are driving the initiative as well, and their incentives and motivation was important. So looking at like IFC and their role in improving the access to finance in the sector and really working towards that, understanding that that was a main goal, helped us get comfortable as well as with the other actors. And then also experience in doing this for other sectors. I think the company that was specifically in charge of data collection and anonymization had a good track record, and that was put front and center during kind of the prospecting phase, and that also helped us become comfortable as well. So generally, this is a kind of a good reputation from the partners that helped us, and visibility into how the process would be run and the results.
Awesome. All right, panel, thank you so much. We've got a lot of questions that have come through in the chat, so I want to get to those. So I'll ask you all to be on standby and feel free to jump in on any question where you want, as well as the three presenters that we had earlier giving us the overview of the KPIs. So let me start with a question from Matthias. He asked, should distributors adapt their financial practices and reporting to the principles of PAYGo Perform, or does PAYGo Perform provide mechanisms to translate? The example being the focus of the KPIs being on cash, but that not necessarily being used by everyone, where there may be revenue recognition that includes some cash, but also some future non-cash revenues. Kevin, did you want to come in on that one?
Sure. Yeah, I mean the use of cash as the sort of baseline for these metrics is indeed a compromise. I mean, there's a reason why accounting has moved beyond cash accounting, because it's you know, it doesn't reflect accruals and many other aspects. But in the case of the PAYGo sector, let's see it as taking a step back to solid ground to create a basis for exchange of information between parties, whether it's funders and the company, or more broadly to benchmark the sector. And we will have to, as a sector, resolve this issue. I mean, what is revenue? What is sales in the sector? So pending that, cash is a good proxy. It's easily calculated. It is, you know, it is not something extra. Every single company that is listening to this, participating in this webinar, tracks its cash on a daily, weekly, monthly, annual basis. So swapping out revenue for cash is the best compromise we could see in terms of complexity and clarity. So you know, we're not mandating that the sector should switch to a cash accounting basis. We're saying that you know, this allows us to project a coherent set of metrics out to the wider world. And this is a work in progress, which will continue through the accounting principles, which we will provide briefing on shortly. So yes, it's a compromise, but it's a good one, and it's easily calculated by, I think, every company involved. Let me pause.
Any thoughts from the panel on that one?
Yeah, if I may add just briefly, I mean, I think most of it said. I would just add that it's also a bit of a reflection of the priority in the current times, right? Where profitability is a big topic, and which means everyone needs actual cash to pay salaries, right? Doesn't help if we necessarily have the profits in our books, but not in cash. And connected to that, also the funding landscape, where I think we all know that at least for certain instruments in certain geographies, etc., there's probably still financing can be a bottleneck, and so cash just naturally becomes even more important. Of course, if it were a lot less of a threshold to raise the funding, to get the funding that that basically bridges the whatever accounting whatever standards you have in your accounting to what you have in cash, that would also be less of a focus. So I do think in the current times that we're in, that certainly it is more important, and hopefully that will change, and that will hopefully coincide as well with accounting standards, etc. Seeing them harmonize as well. But that's maybe just what I wanted to add. That that's why, certainly from our perspective, why this focus on cash is even more important.
Great, thank you. Then maybe another question is basically around the relationship between default rates and the growth of PAYGo companies. So I guess the question maybe to the panel is, do you see a direct relationship between those two, or how do you think about those two objectives of sort of growing your business versus maintaining credit quality?
Sure, I can take that one, Jeff. It's a good question. We have seen some early indications in the data we've collected, but it's still far too sparse to make kind of a broad statement like that. I think if you hold on a little bit, we're going to be showing some data that will show some trends over the past year or so that might give you a sense of where trends are going. But the whole point of PAYGo Perform is to start getting the entire industry reporting on these metrics, so we can start to put together some of the narrative that you're referring to. Is that in fact happening? And I imagine there are other factors involved as well in terms of what the focus is on in the industry. In terms of are investors focusing on top line growth, or are they now focusing a bit more on profitability, which seems to be the case. But we just don't have enough data yet to kind of say so definitively. So hopefully that kind of answers that question. But hold on just a few more minutes, and you're going to get a lot of nice data from Lucia and MFR.
Okay, great. And we will have a second Q&A session. Please, Sarah, go ahead.
Yeah, I know at the industry level, as Nikki has said, you look at the data, but I think it doesn't mean that. I think this will vary with different companies, but growth rate doesn't really necessarily result to default. There are many factors that play, as well as sometimes high growth without very tight controls could lead to defaults. So it's not a positive correlation. So we can just wait for that data that Nikki is going to share. But I just wanted to clarify that it would vary per company.
Yeah, if I can speak there as well. I think we're talking about kind of like pricing risk correctly when we're talking about default rates. If default rates are priced in correctly, then then they shouldn't have much of an effect on the company's march or the sector's march towards profitability. So it's important to just, as a company and as a sector, to make sure that as we get more information on the customer base, that we improve ability to price this risk and pricing defaults, and therefore build pricing plans that attract the majority or the largest number of customers, right? But also do that profitably as well.
Great. Thank you so much. So in the interest of time, I think we're going to close this Q&A session and move on to another presentation, but we will have a second Q&A session. So that may be an opportunity to pick up on some of the questions that we haven't gotten to yet, as well as new questions. If we don't manage to get to your questions, we will follow up on those to make sure that we address them. So let me hand it over now to Lucia from MFR, where she is a business development director. MFR is a specialist rating agency, and they have been doing work under the PAYGo Perform initiative, including the data pilot initiative, and also the PAYGo COVID Impact Monitor, which is what she's going to be presenting just now. And I think, you know, all of us in the industry have spent the last year plus trying to understand, you know, what the impact of COVID is on this industry, on its customers, and data, I think, has been really precious in this process. So let me hand it over to Lucia to walk us through that initiative and some of the data points coming out of that.
Thanks a lot, Geoffrey. Good morning, good afternoon, everyone. This is Lucia Spaggiari from MFR. So indeed, what we're going to see is a use case for the PAYGo Perform KPIs. This is the PAYGo COVID Impact Monitor, PCIM, a data collection effort conducted over the past 10 months by MFR on behalf of IFC, GOGLA, and CGAP to shed light and inform decision makers on the impact of the pandemics on the sector. The sample includes 20 PAYGo firms from 8 countries in Eastern, Southern, and Western Africa. Here, PAYGo firms means a firm incorporated in a country of operations, and so it is different than international groups. This sample is not necessarily representative of the entire sector, as it covers 56% of the PAYGo units sold in Sub-Saharan Africa. What you will see is simple medians, not weighted by the size of company. And another limitation is the attribution challenge. When you see a change, is this due to COVID or to one of the many other items that companies need to manage? Before we start, let me warmly thank all the colleagues in the PAYGo firms who participated to this effort. Your collaboration was extremely appreciated. Without you, this couldn't have been possible. We hope you've appreciated your dashboards, and we remain available for any clarification needed. So first of all, sales continued, but they slowed down. Growth in outstanding receivables moved from a high 108% in 2019 to 38% in 2020. Growth was generally higher in small-scale firms with total assets less than $10 million and lower in medium-scale firms with total assets between $10 and $100 million. This is true both for the growth in outstanding receivables as well as for the growth in receivables generated, with small firms growing more than medium scale, as one would expect. However, both groups saw a similar trend over time, where growth rate decreased from 2019 to 2020. In medium scale firms from 44% to 4%, in small scale firms from 150% to only 48%. Possibly related to the slowdown in sales, we did see an increase in liquidity. The ratio of cash and liquid assets convertible to cash in 90 days over the total cost in the quarter increased from 51% at the end of 2019 until almost double, 89% at the end of 2020. Now, liquidity is not high in absolute terms. Let's be clear, cash flows need to be carefully managed in PAYGo firms, but we did not observe a more severe cash crunch than in business as usual. Another aspect we monitored was potential shifts in the sale model from PAYGo sale to cash sales as a potential response of firms to increased credit risk in markets. We didn't observe that. The percentage of cash flow from PAYGo customers is high and even increased from 96% in 2019 to 97% in 2020. What we did see is an increase in write-off, a significant one. The write-off ratio, which is the amount of receivables written off in the period over the average receivables, increased from 6.9% in 2019 to 13.6% in 2020. 75% of firms wrote off more in 2020 than in 2019. Standard deviation also increased from 7% to 14%. And so the combination of a higher deviation and a positive skew in the data means that some firms wrote off significantly more in 2020 compared to 2019. Write-off was particularly high in small-scale firms, growing from 5.9% to 15.7%, while the increase was relatively of lower magnitude in medium-scale firms, growing from 8.4% to 10.5%. Similarly, we see higher write-off ratios in Western Africa compared to Eastern Africa. However, it's important to note that the Eastern African subsample includes a mix of small and medium-scale firms, while the Western African one is solely composed of small-size firms, which means that these differences may have to do with the size of firms, essentially. This is likely to have an impact on the bottom line of firms. We do not know of how much. Financials were not included in the PCIM for ease of reporting. Portfolio is typically easier to report than financial metrics. What we know from the PAYGo Perform pilot that we conducted earlier on behalf of IFC, GOGLA, and CGAP is that majority of firms on average may not yet have achieved full financial sustainability as described by earning before taxes margin over cash flow. And so such high levels of write-off may have an additional impact on this. Continuing on portfolio quality, we observed a lower, but still a slight deterioration in receivables at risk more than 30 consecutive days late, which is another interesting KPI for portfolio quality. This ratio increased from about 14% at the end of 2019 to about 16% in early 2021, with some seasonal ups and downs. Standard deviation is extremely high on RAR 30 as well. 50% of the firms improved this metric over the period of analysis. 50% of firms worsened. Now, of the firms which improved RAR 30, 75% experienced a higher write-off ratio in 2020. So possibly part of the improvement in RAR 30 may be attributable to higher cleaning of portfolio through write-off. And this is why it is interesting to observe the combined RAR 30 plus write-off ratio, which makes companies with different write-off policies more comparable. This ratio also displays the increase overall in credit risk. The trend in this ratio is driven by the write-off ratio. And this was particularly sensitive as an increase in small-scale firms, increasing from 25% to 38%. Last but not least, we can look at collection rate, which is the cash flow you collected over the cash flow you had scheduled in the period. This is another fundamental KPI, and what we see is that the metric remained overall stable over the period with seasonal ups and downs, improving from 65% at the end of 2019 to 66% at the end of the period. Here again, very high standard deviation, even higher pre-COVID than during COVID time, may signal that COVID may not be the sole or the main driver of changes in collection rate. 50% of firms did better in collection rate over the period, 50% did worse. Of the firms who improved collection rate, 60% experienced higher write-offs, again, to the possible role of write-off in improving collection rate. In conclusion, such a thing as a typical PAYGo firm does not exist yet. Each firm is a different story, and this speaks to the importance of firm-level analysis to complement trend and benchmarking, which we've tried to do. Portfolio quality. More sophisticated analysis shall be done, is welcome, but emerging data are already interesting to show the large potential for portfolio quality to improve and to benefit financial performance of firms. To conclude, this exercise is not perfect, but it does provide a useful illustration of the usefulness of common KPIs to do trend analysis and benchmarking. If you want to improve the quality of the data, use the data. The more we'll measure, the more we'll learn, and this will be useful to manage what's measured and to set realistic expectations. And with this, thanks a lot for your attention. We can open up to Q&A. Please feel free to write your questions in the chat box.
Thank you, Lucia. Maybe while we're waiting for, if you could just mute, we got a bit of an echo on the line. Maybe while we're waiting for more questions to come through, we did have one question from Matthias, who is asking, do the KPI and principles take into account the subsidies or similar revenues, so such as programs from the World Bank, DFIs or governments that are quite prevalent in the sector and which will probably continue developing? So I'll let anyone on the Perform team respond to that. Kevin, do you want to take that one?
Yeah, sure I do. To me, this is a version of the cash question, because at the end of the day, to the extent that a grant or subsidy is coming into the company, it comes down to accounting principles, how it will be recorded. But under the current KPIs, we're not prescriptive. I mean, we're saying at the moment we're using cash as the denominator, and to the extent that cash would come in, it would be captured at one level in the total cash, but it wouldn't be captured within the cash from PAYGo customers or cash from PAYGo sales. So the KPIs are capable of distinguishing and indeed want to focus on the real cash flow from customers, because that's the that is the essential metric in this case. When we look at total cash or liquidity, which is another KPI, it would capture the cash inflows, but it's certainly not. I don't think the KPIs are less comprehensive or in any way lacking the ability to capture the inflows from these sources, but they just appear in a different place. I mean, very similar to the structure of your accounts as they exist already.
And if I can add to that just one small bit, Matthias, one of the points of the unit economics KPIs is to understand how these businesses are working on a kind of a unit basis. So trying to avoid distortive types of financing, such as subsidies. So these, I mean, I think it's a great point that you make, and I think it's one that should be considered overall. But in terms of determining unit economics, if you want to grow a business, understand how close it is to being sustainable and profitable, these things are generally left out. So we're looking at what cash comes in for PAYGo customers, absent any kind of cash that's coming in from other external sources for that bit. But there is a financing component as well, and that is an interesting point and one to consider. Thank you.
Thank you, Kevin. Thank you, Nikki. I want to go back to a question that came through from Paris at Open Capital Advisors earlier in the session. Paris asks Tobias, do you have a rule of thumb for these numbers? So for example, receivables at risk, or Paris uses the example of portfolio at risk, above a certain percentage, would that be considered a red flag? How do you use these KPIs to guide any decisions that you might make? Or is it really a case-by-case basis? So Tobias, do you have any response to that?
Yeah, sure. So, obviously, I think everyone would like to hear very concrete numbers, but I mean, as we have heard, it is in many cases a case by case. However, I would add two elements to it that do make it a bit more general. One is the combination of KPIs. I mean, which I think was also mentioned a few times. Let's take the collection rate or par level. Certainly, if they're very low, that would be a red flag on its own. In combination with unit economics KPIs, if the gross margin is compensating, so to speak, for it, if the company is, so to speak, pricing in that they're maybe serving customers who have a low collection rate or a high default rate, or default risk, that that is an important element that we would want to understand, and that's why one KPI on its own is often, fairly difficult. Of course, there are thresholds, when you get below a certain level. I mean, let's take a PAR 60, right? I mean, customers, even though we would tend to focus on collection rates because that's really, the cash view, but let's still take the PAR 60 example. So customers who haven't paid at all for 60 days, if that's 25% plus, that's of course a real issue for the company. I mean, not only from a financial perspective, even if they have the margins, but just from the basis of the business often being the customer relationship that has a value beyond the contract value of the single item that is sold. There again, what I would recommend, and what for me often is kind of a no-go or a red flag, is if, let's say, I request KPIs and then I get KPIs with very high, especially very bad levels. So let's say a very high PAR or a very low collection rate with no comment. I mean, it's a very easy one, but there might very well be a reason why your PAR 60 is at 20 or 25%, and then add that reason, add what you're doing against it, or if not, why it is okay for your business. So I think in my mind, the red flag is really if in combination, if there's no kind of compensating KPI, so to speak, that compensates for a low or a high value. And the second element is if a bad or a particularly low or high KPI value comes without any explanation or added qualitative element, that often shows to me that maybe the company is not really fully aware that this is an issue. Otherwise, they would point it out. So that's maybe what I would add concretely on this question.
Thank you, Tobias. And just, I know we only have a couple of minutes left in today's session, but I did want to get some of the panelists' reactions to some of the really interesting data that Lucia shared. And obviously recognizing that this is not necessarily a representative sample. And so, there are some limitations to the takeaways that we can make here. But I would be curious, so Sarah, Tobias, Tibian, do you have any reactions upon seeing the data from the impact monitor? Anything that you would want to share with the participants today? Maybe I'll direct this one to Sarah, if that's all right. As sort of a leading PAYGo company, do these results resonate with you, your experience? And then how do you see kind of this insight into how the industry has weathered COVID, kind of helping your decision making moving forward?
Thank you. Can you hear me now? Sorry, it was breaking earlier. Can you hear me now?
Yes, perfect.
Great. So I think looking at the results, they resonate with us as a company. COVID was quite during the time we were collecting data and analyzing this data. It was like the peak of COVID. And one thing that comes for me out of this data is the resilience of the industry to be able to sustain or rather performance even with external shocks. There were a lot of discussions at the time when COVID just started with a lot of lockdowns. There were a lot of initiatives, even from us internally, trying to run pilots to make sure that performance doesn't deteriorate. But one of the things that is coming out clearly is that the sector that we serve, the customers really prioritize energy, products because they are really essential at this time. So that is why we are seeing that there has been a sustainability of performance. And this just tells us, all of us, that such type of metrics, when they are well understood across industry, we can be able to compare across firms and be able to understand how major risks are, what type of data we collect, and how we can be able to share the same with investors as well to give them confidence of this sector. So I would say that it resonates with me and internally Greenlight's performance as well. Thank you.
Great, thank you, Sarah. And really, I know that we're at the top of the hour. I'm sure that we could continue to have this discussion all day, but really, I think that that was a great note to end on, and a really great demonstration of the value of these KPIs. So maybe just to cover what's next. So first off, when you leave the webinar, you'll be prompted to fill out a survey. We really appreciate getting your thoughts on the webinar and the work that the partners have done under the umbrella of Perform. Also, please look forward to receiving a recording of the webinar, and we'll also be planning as well to share any materials that will be coming out. So just a heads up that the technical guide to the KPIs, as well as some of the other tools that come along with it, should be coming out later this week. We'll be sure to send that out to you as soon as they're ready. And of course, should you be interested in any more resources on either the PAYGo solar industry or financial inclusion more broadly, please do visit us at findevgateway.org and cgap.org, and feel free to reach out with any questions you might have. But thank you all for joining, and we look forward to further engagement in the future. Thank you.